a lot of the wells that we've been seeing are offshore in the 25 to 35 to $40 million. If they're kind of just a vanilla conventional drilling, because an MPD can add another 7, 8, 9, 10 million onto an AFE right there, which is kind of crazy. But conventional drilling of that, then yes, that would be a pretty good limit, or sorry, a pretty good AFE on it.
And the other thing to take into account, Jeff mentioned in the presentation about the breakdown in the AFE. We've seen, and Cliff's figures are a good guide as a vanilla figure for the various aspects. We've seen examples of a onshore well being drilled in a very remote area. We talked about Peru. Sometimes the AFE, the funding, will include, because you've got to get lots of equipment,
yes.
You've got to build a camp, you might have to build a road that's hundreds of miles long to get to the site. And so that will be included in the AFE, but will not have an impact on the drilling element, but it will be part of the funding to get to that site to be able to do the drilling. So from an insurance point of view for Control the World, you would be taking out, you'd eliminate all the infrastructure costs to get to the site.
You could also have situations where an appraisal well will be more than have a higher AFE than an exploration well, because they're going to test the living daylights out of it. They're going to do a lot of well testing on there, and well testing can be quite expensive. So it really depends. That's why a breakdown AFE is quite important, so you can work out exactly why you've got to where you are, and then you can come back with a sensible response on what limit they should purchase, because they don't have an idea what limit they should purchase. It's not their business. Yeah? Okay. Thank you. Thank you. So there's been a flood of investment by non-traditional capital into the reinsurance market. This has led to the entire insurance industry becoming overcapitalized. There's been an influx of collateralized structures, which are reinsurance transactions in which the market creates the trust accounts or catastrophe bonds. There's also been an issue that there hasn't been any recent insured NatCats, natural catastrophes, which has made the position worse. I mean, what really can change our market, as you guys know better than most as well, is, if Japan and California fell into the sea from earthquakes, then it will change. Other than that, it's a pretty hard slog, quite frankly. So initially, this overcapitalization, it showed itself with reduced reinsurance costs and increased flexibility in the reinsurance program designs. We started to see a real relaxation on deductibles and on terms and conditions across the board. That had a significant bearing on how the direct insurers that we deal with in the energy market were able to sort of, view the programs. A more recent difference, I guess, probably has been a lot of the downstream energy underwriters have moved into the traditional property market, which is a gigantic sort of vehicle. And that's worked out quite to their advantage. They're being a lot less restrictive on imposing some of the conditions that apply to a lot of the traditional energy non-marine markets, such as the cyber exclusion clause 380 and things like that. We're seeing that not apply to a lot of the direct insurers treaties facilities, which traditionally you would not see in the energy market. So this overcapitalization has disrupted the industry in many ways. There's been a lot of mergers and acquisitions in the insurance market as companies shift their focus from the top line growth to defending the bottom line to control costs. And it's actually not just insurance companies. There's been a lot of brokers that have actually merged in the last few years for much the same reason. So you got a smaller number of the bigger insurers, and it will reduce the amount of reinsurance purchase from the specialist reinsurance market. So the small reinsurers are in a very difficult part of the industry space right now, and which has been evidenced by them continually looking for. I tell you, if you've got some spare cash, go out for some of the smaller Lloyd's companies right now. You might make some money out of it. I don't have any spare cash, so hence that's why I'm still standing here. Okay, so this overcapitalization has triggered a softening in the majority of the insurance and reinsurance classes. The softening is now feeding through to specialty markets like energy insurance, and it's even shown the last couple of years where it's gone softer in the energy market. It was really holding, the NatCat market was still holding pretty solid, But we've heard signs that that's even changing now. So it's becoming soft across the board, quite frankly. So what else has been going on? There's been quite a few adverse developments in the energy industry. The dollar, the strength of the dollar has seen a significant growth in the tight hydrocarbon production, which has triggered a collapse in the oil price. And Cliff talked quite a lot about the tight oil and what that's been doing. With the oil price being down to where it is now, it's making stuff pretty difficult. The upstream sector is focusing on reducing a lot of costs, and we're seeing a significant reduction in capital expenditure, which is associated with the construction industry. Operating expense is also being reduced, and that's a concern to a lot of underwriters because, if they're not putting money towards the maintenance of these facilities, then, long term that can't be a good thing. So Cliff talked about the fire sale that's going on now with a lot of the contractors where, they paid $700–800 million for a facility, and you can go out and for a bit of spare cash of $300 million, you can buy yourself a new facility. We're seeing a lot of long-term contracts that have been, with operations in Brazil that have been canceled because they had clauses in there which allowed them to do that, subject to certain sort of penalties. And what we're seeing a lot of now is a lot of the long-term contracts that were in place for drilling contractors, where they may have, some of the big operating companies may have had 35, 40 rigs on contract. They've now reduced a lot of those to, say, 12, 13, 14, 15. So there's a significant reduction in across the board in all contractors. Rob was talking about the seismic market, and that has a knock-on. The whole thing has just a knock-on effect. So there's a lot of sort of bad news out there right now. So we've still got high levels of production from OPEC and the USA and Russia. I mean, the Saudis are leading the charge on this front. They're refusing to reduce the amount of production that's going on. I mean, I think it's estimated that there's 3 billion barrels of oil right now on surplus oil, which is a significant amount. You've also got the improvements in tight oil production. The Americans have been able to sort of produce shale oil. At a time there, they needed to probably have, $70, $80 a barrel to make it lucrative to do shale. And in the last 18 months, they've been able to reduce that by half. So there's been significant inroads technology-wise in the shale oil. You've got the coal bed methane and also enhanced oil recovery operations. So there seems to be no let-up really right now in the oversupply, and I don't think that OPEC's going to change their mind. I mean, some people are suffering. The Venezuelans, for example, I mean, their economy is predominantly driven by PDVSA and the oil industry. It's a kind of a semi-socialist type environment where it's heavily subsidized for all of their standard of living costs. And they're in OPEC, and they don't want this to continue, but they don't really have much choice in it. Malaysia, for example, Petronas generates sort of a 42%, I think, of the GDP for the entire country. So it's a very petroleum-driven economy. And there's a lot of, I think Indonesia has a similar type situation. So it might be okay for Saudi and for Kuwait and stuff like that, and Qatar and Abu Dhabi's got, more money than God. So, they can hang out for quite a while. But for a lot of other people, it's not a very good time. And we're not even taking into consideration the fact that Iran and Iraq Iraq, they're doing quite a bit of production right now, but they're kind of waiting more for the price to change. But, and the negotiations are ongoing with Iran. Once Iran gets the green light, there's a number of companies that'll go into there. So, that's just contribute to the problem, I think. It's not, well, it is a problem, but. Okay, so we got a situation where the insurance market is overcapitalized and it's softening. The specialty markets like energy are hugely affected by it. And then we have the industry where the energy insurance markets are both simultaneously depressed. So it's not a lively or encouraging picture. I'll try to throw some jokes in here at some time, but the energy market's not really having a good time. But thank you for inviting us. We're grateful to come down. Okay, so just continuing. So as you guys know, because you've been in the industry a long time, the energy business and the insurance business as a whole is very cyclical. It comes around and goes around. I don't know really, if I had a crystal ball, I probably wouldn't be standing here right now, but I mean, from the last time there was a soft market, it only lasted really for 2 years, but the fact of the matter is that it wasn't a perfect storm. There wasn't the oil price situation, there wasn't the financial crisis that had happened there, so that, the circumstances were quite different. So we don't really know how long. If I'm talking to some of the underwriters that I speak to them all the time, some of them are saying 7 years, which to me is a fairly long period of time, but I don't think anybody really knows, but it will, it will eventually turn around. This phenomenon will pass, and the good times will roll again, but we just don't know how long it's going to take. So let's just do a quick snapshot look at the 2015 energy market. Okay, so this slide shows the number of insurers worldwide from 1996 to 2015. These are energy insurers, sorry. And you could see that in 98 and 99, there was a huge number of, 120 odd, I can remember even 130 underwriters back in the sort of that period of time that were writing energy business. But a lot of those markets were very small. So their capacity might have been 10, 15, 25 million, not a huge number for energy business. So they, having that small capacity, it didn't really sort of affect things. But what was interesting with it was that you can see sort of how the numbers sort of drop. And there's a slide that I'll show you next, which actually correlates the number with the capacity. There are new entrants that are coming into the market. We've seen Dual and NOA and Houston International. There's been quite a few new markets that are in the energy business, most of them based in London. Most of them have quite small capacity, and some of them have been quite aggressive, but they've been under the scrutiny of the Lloyd's Performance Market Directive, which is headed up by Tom Bolt and his team. And what they're doing is they approve all the budgets that the syndicates have, and so whatever they're actually it's effectively their budget plans that they have, and so they have to be approved by this directorate. And he's particularly hard, or they, I should say, the group are pretty hard on a lot of these guys that are, if they feel that they're actually being overly aggressive rating-wise and that, which is kind of rich in today's market. But so you see a lot of that going on right now. Okay, this slide here is just, why is the market capacity increasing? Well, there's a number of factors. Quite frankly, the insurance sector is just awash with cash. There's just a lot of money out there available. You've got the low interest rates, so where are the money men going to go? They're going to come into insurance. It's worked in the past. It'll work in the future. The upstream market, surprisingly, has remained reasonably profitable since 2008, which was effectively Hurricane Ike. The upstream infrastructure, though, the values have increased significantly. So we're finding that we're always increasing or totally increasing either the scheduled values or the limits that are associated with these particular assets. So it's resulting in the insurers having to increase their capacity in order just to sort of be able to maintain their market signings and their participations on the program. So, you kind of have to move forward quite a lot just to stand still, in order to keep their existing revenue streams.
Are you saying the total market capacity is 5.5 million?
Well, what we've got here is, if you look at this right here, it's actually near 7. 7 billion is really the estimated, but that is, they never use, like if an underwriter has a 50 million capacity stamp, he might write 40. There's very few of them that write to their limit. Some of them like to go there, but most of the market underwriters, they might write 75% of their available capacity. But what we're saying is that it's the realistic capacity is really the blue one here, right? So that 5.5 near to 6 billion is really what we're seeing.
That 7 billion would include mutuals like OAL and would include captive insurance companies, not necessarily commercially available market capacity.
It's not pure commercial.
It's the capacity offered by the biggest player, or it's a total market capacity?
Total.
Then what would happen if someone comes with a risk where 20 billion is the requirement, as we spoke?
They won't get covered.
No.
And also, when you talk about capacity in this way, that assumes you're paying top dollar.
Yeah.
You know, you've got to pay the right premium and have the right risk to generate anything like that.
There's a lot of Paul's right. There's a lot of underwriters that just ride out the storm. Their view is that we're going to, you know, they're not under pressure to write premium income. It really depends on the nature of the company. If an underwriter's got, you know, heavy investment from, you know, from the financial services industry, they're under a different kind of pressure. They need to see some results. These guys don't hang around, so they need to see results fairly quickly. But if you get the big boys like your AIGs and some of the guys like that, they can sit there and they can be more, they can pick and choose. It really depends on the pressure they have from their management on what their, you know, what their results are to be. And quite a lot of the underwriters, you know, they'll just sit there and they'll just ride it out. They'll continue to write core business that they have, and that's, they might have only half a dozen of major accounts which they have a serious participation on, and they'll ride that out. And then they, you know, some of the guys are dropping out of construction, for example. They're just saying, well, the prices are bonkers. The conditions are not really lessening too much, but a little bit. Deductibles are coming, you know, they're staying more or less flat. I'll talk about that a little bit later in here. But feel free to, you know, holler in anytime you want. Okay, so the upstream losses, this slide just depicts the 2015 with a bit of an update from 2014. These are upstream energy losses that exceed excess of 50 million. I've got sort of maybe a typo in there. There's a notable increase actually in here of Latin American losses. If you see here, I think we had about 2 last year, and I think there's 7 this year. So there's been a lot of activity where things have gone a little bit wrong, I guess, in Brazil and quite a few other places in Latin America. There's 4 losses above 100 million already. I think in 2014 there was 1 loss in excess of 100 million. And this doesn't even include a couple of big losses that have recently happened. There's the Chevron Bigfoot in the Gulf of Mexico. I don't know if you've read about that. I'm not sure how high that loss is going to get to, but it's a pretty big one. And they've had an incident where they had some anchor issues where I think 9 of the 16, they had these kind of semi-new technology with that, with those mile-long anchors, and they had 16 of them, and 9 of them have actually sunk to the bottom. So they've got a design problem going on there. And yeah. So and it was near completion too, I think it was. So then there's been a few other ones that are not included here. There's BW offshore, and the big Pemex one is also, I think that is included in here. But you can see why there's been, you know, an increase, but you know, if you look at the total, there's 1.893 billion right there, and 559 million or so in 2014. But I'll show you, you know, when you take it in relation to the premium amount, which is what this next slide will do. If you see here, you've got 2015 premium is estimated to be, you know, less than 2 billion. We've already got 1.8 billion of assets, and that's without deterioration. If you want to get an idea about how deterioration works, just take a look at these here. The green amounts there were what the losses were at last year, and so the gray bit that's just above them is deterioration that's happened since this time last year, effectively. So it shows the comparison of the losses, you know, and the premium income that has been going on really since 2000. These spikes here, 2005, Katrina and Rita. I'll put this up a little bit, sorry. The 2008 is Ike. The 2010 is Deep Sea Horizon. We've probably bored you to death about Deep Sea Horizon, but I'm going to bore you some more. So if you look on here, you've got this line here, this red line, that depicts the estimated worldwide offshore premium. Now, who'd be an underwriter, you got to ask yourself sometimes. If you look at that, they made a bit of a profit in 2000. They made a little bit of a profit in 2002. That's pretty bad. That's bad. That's bad. Yeah, just about even. That's bad. That's bad. So those years, they survived okay because there was lots of investment income. And right now, there's not a lot of investment income. So, you know, they're underwriting more for profit now. And so, you know, the whole dynamics has changed quite considerably in the last couple of years. But the reported losses in 2015 have already passed 2014. So it'll be interesting to see how it ends up. Okay, so the upstream energy premium versus claims. The market runs at a profit or at a loss. There will always be winners and there's losers. The difference will be down to a variety of factors. Well, you know, hate to say it, but luck is probably one of the main ones. You got a better spread of i.e. portfolio effect. If you've got a good cross-section of classes of businesses across a wide area, you've got a better chance of sort of seeing through. Just better knowledge and understandings about the quality of the risk, which is why it's so important and why a lot of the underwriters are buying into really a lot of the engineer-focused type risks. Because if it's not something that you're totally comfortable with, maybe you can write it at a premium level that actually makes it worthwhile doing. So there's that area to it. But then, of course, you've got better or more relevant reinsurance programs. I mean, there's been a significant increase in direct insurers buying, where they maybe last year they might have, you know, bought excess of $40–50 million. They're now buying excess of $10 million because it's cheaper. When the reinsurance market goes cheap, you know, you may as well just go with the flow a bit. You know, go down with them, track them down, and then sort of move up when it becomes more expensive. Or there's a lot of quota share type placements that are out there right now that are really affordable. So, you know, forget the excess of loss, go back to quota share, you know, follow the market, just go with it. Just keep going. So in the short term, luck is one of the most important factors. Long term, it'll be the knowledge, the spread of business, and more relevant reinsurance. So London is the hub of the energy insurance business. I think we all agree to that. So the best information and access, it has the best access to reinsurance, can operate in environments where the overall market runs at a loss. And this is what we're doing right now. Okay, so this graph shows how the average rating levels have moved in comparative terms since 1993 compared to the maximum, and I say theoretical because, I mean, we're going theoretical because we don't know how much everybody uses. We've got a pretty good idea. And for the market capacity that's provided. So if you look at this particular graph, here the blue tracks the upstream capacities, yeah? And the red is the average composite percentage. So how this kind of graph works, this is your kind of baseline here. So your 1992 rate would have been, if you go across here, that's your baseline. So 100 is right there as your baseline. Whenever you've seen an increase in capacity, it's generally tracks with a downturn in the composite rates, because more capacity just brings in cheaper prices. That's all it does. Again, gone up here quite a lot with the rates went up here quite a lot. This is post sort of 9/11. So the market hardened quite a bit across the board. It didn't matter what sector you were in, it was bad news for a while. And again, it's just kind of dipping, but to predict that, you know, here's a soft market coming on here the last couple of years, but the probable landing zone is, you know, around 60, which is still, you know, 60% of what the baseline rate was in 1992. So it's bad, but it's been worse before. I mean, again, it's really just this perfect storm of having the no options to go anywhere else type thing. So we're still well ahead of the late 1990s soft market, 98, 99. You can probably gather by my inclination here that I'm not a fan of soft markets. I don't like them at all. They're too boring. There's nothing going on. You know, you can send a chimpanzee out to do it half the time. It just doesn't make any sense to me. But anyway, that's just my own. It's not an opinion of Price Forbes. It's just my own opinion. Right. Okay. So, what are the current trends in the upstream operating? Well, the rating and capacity rates are getting back to their 2008 levels, but they're still way higher than at the end of the 1990s. It's a very odd market, though. You know, respected leaders are giving instructions, but are doing so in a measured way with a view to the sustainability of their customers' insurance programs. So, like I say, now is a time to have, you know, where your relationships that you've established previously are really bearing fruit. It's basically allowing the customer to sort of meet the requirements of their management, and hopefully the underwriters to meet the requirements of their management. So there's been respected leads, and new alternative markets are also there, declining some of the risks. Stating reasons are inadequate premium. I think I elaborated on that on a couple slides before. I mean, there's a sign that they're being quite picky about what they do, and so hopefully for a lot of our customers, we have a very solid market base that's been with them for a long time, so we hopefully won't be affected. What was interesting was there's a facility in the London market that is placed by Miller's, which is a TRS facility. And I think some of you here may have met some of the TRS people in the past, I don't know. And they have this facility that's been going for a number of years. It's predominantly in Indonesia. They also do a lot in Myanmar and Cambodia and Bangladesh, and certain markets where the market's not over sophisticated. You might not see them here because you've got a pretty sophisticated market here. You've got a lot of insurers. They kind of do better in places that are a little bit more monopolized. I mean, they're in Mozambique right now because there's not many unchanged for the operating risks. Oop. Have I gone too far? Yeah, I think I have. Okay, so the carriers and leadership. So the opportunities do exist to move to alternative leaders. Chris Wilde, who was a very well-recognized market lead in London in the 90s and has been working for Chaucer in Singapore for a number of years. He's moved back to London, and because of his standing in the market, he's been able to sort of turn into being quite a viable leader for Aspen Syndicate, which is who he underwrites for now in London. We're seeing Emirates move into a leadership role, which is quite considerable. I mean, the problem with a lot of the markets outside of London is that to be a leader, you've got to be able to service the claims. You've got to have a certain knowledge of energy business, which is quite intricate and quite technical. So you need to be fairly sizable in order to do that, and you have to have enough capacity to write a lead line that warrants the following market to sort of wake up and pay attention. So again, I referred earlier about the cyclical market. It's inevitable that it will become difficult again in due course. So it's really more reasonable to stick with the proven low-cost, reliable suppliers. And if they follow you when the market goes down, then it holds well for the future. And that's really what we're quite fortunate with. We've got a lot of underwriters that stay with us for a long, long time. And we mentioned earlier that we have very good account retention. A lot of our accounts we've had for well over 20 years. So it works quite well. And it's a saving grace when the market's hard, and it's a saving grace when the market's soft. Okay, so what's going to happen? Well, soft markets invariably mean that markets are going to go insolvent. I mean, you have to be relevant. And if you're not actually, if you're running around with $40 or $50 million in London, it's going to be hard to be relevant. I mean, if you've got relationships, then you'll probably ride it through. But if you're just coming into the market and trying to crack some new accounts, when there's not really that much capacity needed because everybody's got there's so much awash with it, that it's going to be a tough time for some of them. So I think invariably, it's going to be very damaging for a number of underwriters. But as I said before, if you've got a quality assured, then you're gonna come out of it okay. Still sort of get some deals done when they're there. The rates remain relatively stable for the large projects that require capacity demands. There's some real softness though in smaller projects, and in excess layers covers as alternative leaders begin to appear. What's been happening a lot on that front is, because of the number of smaller underwriters that are coming into the equation, smaller I mean capacity-wise, maybe between 25 and 40 million. What their appetite is really now for is the brokers are really designing the program different. We're going on to layered construction projects and trying to fit areas where they can fit in. If they want to fit in at the bottom, I love them. But generally speaking, they'll be slotting in somewhere on an XOL basis, or maybe doing a bit of a tower combination. So that's been quite an interesting development because 8-9 years ago you didn't really see a lot of layered programs unless the construction project was very, very large. So what else we've got here? As far as the conditions are concerned, well car is still being used. I don't know if you're familiar with the well car, but it was a wording that was put into the market around 2001 by the Wellington Syndicate with a lot of assistance from other underwriters who didn't get much credit. That's Paul Mundy griping. And that wording has been in place in forms, variations. I mean, the best thing is you say well car 2001 amended. Then it just opens up the whole thing for whatever you might want to do with it. But it is the standard market wording. There's no getting over it. Zurich had a wording that we used for a lot of times, and we still do, but it's a variation on the theme. Gives you different, less restrictions and things like that. But you have to have a market that is familiar with it, that is stable with it. As I said the other day, we don't do Schedule A and Schedule B on our placements, generally. Again, because we use the underwriters that are familiar with that. So there are ways around everything, but this is really about how the market is in general terms. So we're seeing mobilization and demobilization back in vogue. That was really a problem for a while. There was a lot of problems with marine spreads, and there was a lot of claims for standby and various other types of additional coverages, which really hurt the market quite badly. And so whilst we're not really seeing deductibles change too much, we are seeing some of the additional coverages, which in a soft market you need to have, because you have to have something a little bit different. So if you can't change on that way, then you're not really adding too much value. And okay, so again, I was alluding to the fact that there's a number of another number of brokers that are trying to sort of get rid of the Schedule A, Schedule B scenario. There's some real pushback from the traditional construction market, but it's something that we're seeing happening out there. There's also some resistance to the Marine Warranty Survey appointment, and this winds me up no end. I mean, we're a firm believer in the Marine Warranty Survey document as being added value for any construction project. I would say that, I guess, because Cliff and I have been involved with that, with James Miller at ACE and before that at Zurich for a lot of years, and it's really a great document, I think, and it's gone a long way to eradicating a lot of the problems that there were with construction projects, because it was delinquent. I mean, you couldn't